Every time the stock market crashes, the headlines sound terrifying. Trillions of dollars wiped out. Markets destroyed. Investors lose everything. It feels like money is vanishing into thin air. Portfolios collapse, charts turn red, panic spreads across financial media. But here is the uncomfortable truth most investors never stop to question. Where does that money actually go? Did trillions of dollars physically disappear? Did someone secretly take it? Or was that wealth never really sitting there as cash in the first place? Because once you understand what really happens during a market crash, something important changes. You stop seeing crashes as destruction, and you start seeing them as transfers. Not the end of money, but the movement of money. And understanding that single idea can completely change how you see markets, risk, and opportunity. The illusion of financial security, a precarious balance between liquid assets and volatile markets. Most people grow up believing wealth is simple. Work hard. Save money. Invest in the market. And over time, your portfolio grows. But what very few people are taught is that the market is not a savings account. It is a pricing system. Every stock price you see on your screen is simply the latest agreement between buyers and sellers. Nothing more. Nothing less. That means the value of your investments is not fixed. It is constantly being negotiated by millions of participants around the world. Institutional investors, hedge funds, pension funds, algorithmic trading systems. Retail investors, and global capital flows. Prices move because opinions change, because expectations shift, because fear and optimism constantly compete. This is why markets can rise for years and then suddenly collapse in months. The illusion people fall into is believing the number they see in their portfolio is permanent wealth. But in reality, it is just the latest market estimate of value. An estimate that can change tomorrow. Understanding this is the first step to understanding market crashes. Because when markets fall, money is not being burned or deleted. Something else is happening. Something far more strategic. Main body, part 1. What actually happens during a market crash is a cascade of falling prices, draining liquidity, and panicked selling. When headlines say the stock market lost trillions of dollars, most people imagine something dramatic. They picture money disappearing from the system. But that is not what happens. The stock market is essentially a massive auction. Every stock price exists because someone is willing to buy at that price, and someone else is willing to sell. When fear enters the market, sellers become more aggressive. Buyers become cautious. And the auction price drops. If a company has 1 billion shares trading at $100 each, the company's market value is $100 billion.
If fear pushes the price down to $80 per share, the market value falls to $80 billion.
Financial media will say the market lost $20 billion.
But no vault was emptied. No $20 billion stack of cash disappeared. The price simply changed.
The same way the estimated value of a house can change depending on market conditions.
If your home's value drops, it doesn't vanish from your account. It means the market's opinion changed. Stocks operate the same way. It means the market's opinion changed. Stocks operate exactly the same way. The market is constantly repricing assets based on expectations. And expectations change rapidly during uncertainty. Economic slowdowns. Interest rate hikes. Corporate earnings disappointments. Geopolitical instability. All of these forces influence how investors price risk. When fear spreads, investors demand lower prices before they are willing to buy. And that creates the appearance of wealth disappearing. But the money itself is not gone. The price has simply adjusted. Paper losses versus real losses. Another critical concept most investors misunderstand is the difference between paper losses and realized losses. If you buy a stock at $100 and the price drops to $60, your portfolio shows a 40% decline.
But unless you sell the stock, that loss is not realized.
you still own the same number of shares. The market is simply offering a lower price today. Your loss only becomes real when you sell the asset. That moment converts a temporary market fluctuation into a permanent financial outcome. And this is where psychology becomes the real driver of market crashes. Because during panic events, many investors stop thinking strategically. They react emotionally. Fear takes over. They sell not because the asset suddenly became worthless, but because uncertainty feels unbearable. And when large numbers of investors panic simultaneously, the selling accelerates. Prices fall faster. Fear spreads wider. And the cycle feeds itself. Smart money versus panic selling. Calm institutional buyers accumulate assets, while panicked retail sellers offload at a loss. Every trade in the market has two sides. For every seller, there is a buyer. When someone panic sells during a crash, another participant is stepping in to purchase that asset, often at a significantly lower price. This is where the concept of smart money becomes important. Institutional investors, large funds, and long-term capital allocators often prepare for volatility in advance. They build cash reserves. They manage risk exposure. They wait for moments when fear pushes prices far below long-term value. When panic selling begins, these institutions step in. Not emotionally. Strategically. They accumulate assets that are suddenly trading at discounts. What looks like destruction to one investor can look like opportunity to another. And this is one of the most misunderstood aspects of financial markets. Market crashes are not just collapses. They are transfers. Assets move from emotionally driven sellers to strategically prepared buyers. How capital rotates during market fear. When markets crash, capital rarely disappears. Instead, it moves. Investors rotate money into assets that feel safer during uncertainty. This often includes government bonds, cash positions, money market funds, gold, and other perceived safe haven assets. Historically, during major market stress events, investors increase allocations to safer instruments while reducing exposure to riskier assets like equities. For example, during periods of market uncertainty, demand for U.S. Treasury bonds often increases because they are widely considered one of the safest financial assets globally. Source: U.S. Department of the Treasury. Similarly, gold has historically attracted investor demand during financial instability because it is viewed as a store of value when confidence in financial markets declines. Source to World Gold Council. This movement of capital is called asset rotation. Money flows away from risk towards safety until confidence begins to return.
Forced selling and market spirals.
Market crashes can also accelerate due to a mechanism called forced selling. Many large investors use leverage. This means they borrow money to increase their investment positions. Leverage magnifies potential returns, but it also magnifies risk. If leverage positions lose value quickly, lenders may require investors to add more collateral. If they cannot provide additional funds, positions are automatically liquidated. This process is known as a margin call. This is one reason crashes can feel sudden and violent. It is not just voluntary selling. According to the U.S. Securities and Exchange Commission, margin calls occur when the equity in a margin account falls below the broker's required maintenance level. Source: USS Investor Bulletin on Margin Accounts. This bulletin explains the basics of margin accounts and associated risks. When margin calls happen across many leveraged investors simultaneously, forced selling increases. Prices drop faster. More margin calls are triggered, and the selling cascade accelerates. This is one reason crashes can feel sudden and violent. It is not just voluntary selling. It is mechanical liquidation. Main body, Part 2. Positioning for long-term financial growth. Market crashes are frightening in the moment. But historically, markets have also shown the ability to recover and grow over long periods. For example, the S&P 500 index has historically delivered an average annual return of roughly 10% before inflation since 1926, though returns vary widely from year to year. Source: Ebbetson Associates Historical Market Data. This does not mean every crash is quickly reversed. Recoveries can take time, sometimes years.
But long-term investors who stay disciplined often benefit from market growth over decades.
This is why financial positioning matters more than short-term reactions. Successful investors focus on systems, not emotions. They diversify. They manage risk. They maintain liquidity. And they prepare for volatility instead of fearing it. Growing small capital strategically. One of the biggest myths about investing is that you need enormous starting capital. In reality, consistency often matters more than size. Regular investing combined with compound growth can produce powerful results over time. Compound growth occurs when investment returns generate additional returns in the future. According to the U.S. Securities and Exchange Commission, compound returns allow investors to earn returns on both their initial investment and the accumulated gains from previous periods.
Source: Sesar.gov, Compound Interest Explanation.
This is why long-term investors often focus on disciplined contributions rather than attempting to predict every market movement. Time becomes a powerful ally. The future of markets, technology, and structure. Financial markets are also evolving rapidly. Artificial intelligence, algorithmic trading, automated portfolio management, data-driven risk analysis. These technologies are reshaping how markets operate. According to research from the Bank for International Settlements, algorithmic and high-frequency trading now account for a significant portion of market activity in many global exchanges.
Source: Bank for International Settlements, Market Structure Reports.
But even as technology evolves, one thing remains constant: human psychology. Fear, greed, overconfidence, herd behavior. Markets are still influenced by emotional reactions to uncertainty, which means the biggest advantage an investor can develop is not predicting markets perfectly.
It is managing their own behavior.
Psychological shift, from emotional trading to disciplined strategy.
Markets move. Emotion reacts. Structure adapts. Fear spreads quickly.
Patience compounds quietly. Crowds chase momentum.
Professionals manage risk. News amplifies panic. Data reveals opportunity. Impulses trigger mistakes. Systems prevent them. Short-term noise distracts. Long-term discipline builds wealth. Money does not reward urgency.
Money rewards preparation.
Power outro. The next time markets crash and headlines scream about trillions being lost, remember something most investors forget. The money did not disappear. The price changed. The assets moved. Ownership shifted.
From panic to patience.
From reaction to preparation. From emotion to strategy. Markets will always cycle. Fear will always return.
But those who understand the structure behind the chaos begin to see crashes differently.
Not as financial destruction, but as moments of repositioning, because this is not gambling.
This is calculated positioning. And once you understand how money really moves through the market, welcome to Finance Hustle.